Movie theaters make almost no money from ticket sales, and the system was designed that way. Studios take roughly 50 to 70% of opening weekend ticket revenue. By week 3, that number climbs even higher. A theater owner in Des Moines showing a blockbuster isn't banking the windfall you'd imagine. The math is inverted. Tickets are the loss leader. Popcorn is the engine. Exhibit 1. In 1992, the National Association of Theater Owners published data showing concession sales, popcorn, candy, soda, accounted for roughly 20% of total revenue. By the 2010s, that number had shifted. For many independent and regional chains, concessions now represent 40 to 50% of operating profit. Tickets pay for the building. Snacks pay for survival. Why the squeeze? Studios didn't always control distribution so tightly. In the mid-20th century, theater owners negotiated differently. They kept more. But as vertical integration tightened, studios owning multiplexes, releasing films in waves, demanding premium formats, the negotiating power flipped. Studios now dictate terms. Theaters adapted by pricing concessions aggressively. Exhibit 2. The cost structure of a popcorn kernel is nearly invisible. A pound of unpopped kernels costs a theater operator roughly 50 cents to 75 cents. Oil, salt, butter, flavoring, another 25 cents. Labor to pop and serve, maybe 50 cents. Total input cost per large bucket under $2. The selling price $14 to $18. The margin isn't profit, it's survival math. But here's what the numbers don't capture. Theaters operate on razor-thin overall margins. A typical multiplex might clear 5 to 8% net profit after all expenses, rent, utilities, labor, insurance, equipment maintenance. That's not greed, that's structural fragility. One bad quarter of weak releases can flip a profitable location into red. Exhibit 3. Compare the economics to fast food. A McDonald's franchise can negotiate bulk purchasing power across thousands of locations. A regional theater chain, say, 40 screens across 3 states can't. They buy popcorn kernels and cups at retail markup, not wholesale. They can't leverage scale, so they compress margins by raising price. The pricing is also psychological. Customers expect to pay more at a theater than at home. It's a venue premium like a stadium hot dog or a concert t-shirt. The theater operator knows you won't bring outside snacks. You're trapped in a scarcity loop, no competition inside the walls. Demand is inelastic, price accordingly. But the real story is older than you might think. Movie theaters didn't invent the snack markup model, they inherited it. In the 1920s and 30s, when theaters first added concessions, they were an afterthought, a way to occupy lobby space. By the 1950s, as television threatened box office, snacks became strategic. The feedback loop began. Lower ticket margins forced higher snack prices. Exhibit 4. The pandemic revealed this system's fragility. When theaters closed in 2020, chains that had relied on concession margins to offset low ticket revenue faced existential crisis. Some never reopened. The ones that did came back with higher prices across the board, tickets and snacks. Not greed, debt service. They'd burned cash for months with zero revenue. Today's $18 popcorn isn't random. It's the output of a system where studios control supply, theaters control demand, and the customer has no leverage. You can't negotiate. You can't bring your own. You can skip the snack, but the theaters already factored that into ticket pricing. The margin is baked in either way. So what happens next? Some chains have experimented with lower concession prices to drive volume. The theory, $6 popcorn sells more buckets, offsetting lower per unit margin. It hasn't scaled widely. Why? Because the margins work. Customers pay. Demand remains. There's no incentive to change a system that, however painful, keeps theaters open. The deeper pattern here is a feedback loop that analysts saw coming decades ago. As studios consolidated, theater margins compressed. As margins compressed, prices rose. As prices rose, fewer people attended. As attendance fell, the remaining customers bore higher costs. Each cycle tightened the spring. The system wasn't broken. It was operating exactly as designed, extracting maximum revenue from shrinking demand. None of this is secret. Theater operators, studio executives, and industry analysts have discussed these economics openly for years. The surprise isn't that popcorn costs $18. The surprise is that anyone expected it to cost less, given the structural constraints that make it the only lever left. You're not being gouged because popcorn is expensive to make. You're being charged what the market will bear because the theater has no other way to survive. It's not a conspiracy. It's economics. And once you see the system, you can't unsee it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for the next deep dive into the economic systems hiding in plain sight. This video is for educational and informational purposes only and is not financial advice. Always do your own research.